ULTI dropped again, and I wasn't alone. Today, I'm breaking down the real story behind ULTY, WPAY, ULTI with the I, KYLD, and block, the high beta names they rely on, SPY, RSP, and exactly what the broader market is doing that nobody's talking about. If you're in any income ETF right now, you need to see this.
Here we go.
And a quick reminder, none of this is financial advice. This is just what I am doing with my money inside of ULTY. Welcome back, dividend stackers. If you're new here, this channel documents my journey building weekly income using YieldMax's ULTY ETF with margin, drip, and real life decisions along the way. And real quick, if you're getting value or just simply plain entertained from this journey, hit that subscribe button so you don't miss these weekly updates. Now let's jump into the numbers. Let's start with the portfolio, full transparency like always. ULTI is sitting at $3.99. I currently hold 2,726 shares with a cost basis of $5.51, totaling $15,031 invested. My current market value is sitting at $10,876. That puts my unrealized loss at a negative $4,154 or a negative 27.64%, including dividends, which totals $19.86. My true gain, including dividends, is a negative 16.62%. Real numbers, real results, no sugarcoat here. On the margin side, I'm using $860 with a 62% buffer. The maintenance requirement is $3,807, and my equity sits at $10,015. The daily interest, still zero because $1,000 interest free because of Robinhood Gold. This buffer is why I'm calm, even with ULTY dropping. YieldMax posted the new ULTY distribution at 0.0642 cents per share, with a distribution rate of 80.65%. The cash amount has dipped slightly, but the distribution rate, the percentage of income paid out, actually went up this week. So what does that tell us? Premiums were lower again, the market volatility compressed, and ULTY still paid out more of what it generated this week. My last 3 weekly deposits were $201.73, $163.01, and lastly $167.18. Still hitting every Thursday now, just adjusting to volatility like always. Here's where things get interesting. Look at what the underlying high beta names have done. ULTI has not fallen on its own. Every single one of the stocks that generate premiums for these type of income ETFs all have followed together. This is a systematic drawdown, not a ULTY accident. And here another view. ULTY in the white, everything has drawn down, especially starting on November 1st. So let's compare the funds. ULTY, WPAY, ULTI with the I, KYLD, and blocks, all in the negative. So the idea that ULTY is the only one dropping is not true. Some of these are down even more than ULTY. This is structural, not ticker specific. And here's the bigger market truth. SPY, the cap weighted index, is up 16%. RSP, which is the equal weight S&P, is only up 5.92%. This tells you everything. A handful of mega caps, Apple, Microsoft, Nvidia, has held the market together. The bottom 400 plus stocks, they have been bleeding. Guess which side of income ETFs correlate with? Not the mega caps, not the safe names. They correlate with the side of the market that's actually down. Even SPY finally broke down out of its rising channel, multiple sell signals, falling volume, and the trend support snap. When the generals weaken, the soldiers collapse first. Income ETFs, they are the soldiers. All right, now it's time for the macro minute where we zoom out and see what really moved the markets this week. We kick things off with the delayed September jobs report, and it actually surprised to the upside. The US added 119,000 jobs, beating expectations, even as unemployment rate crept up to 4.4%. Markets took that as a sign of cooling, but not collapsing, and that's the labor market. But the real headline was the world's biggest company basically telling investors to chill out about the macro noise. And the Fed not buying the optimism. Fed Collins doubled down this week, saying she's still leaning against rate cuts in December because inflation's sticky and the labor market hasn't softened enough. That kept pressure on yields. They dipped early in the week but bounced back on the Fed talk. leaving traders stuck in this weird and wait-see mode. And for the first time in weeks, volatility actually woke up. The VIX had its biggest weekly jump in more than a month, signaling traders are finally hedging again. Oil eased again, easing inflation pressure but pointing to softer global demand, while Bitcoin stalled after its latest run-up and crashed, falling to 80,000 for the first time in a long time. Bottom line is stronger than expected jobs number, a cautious Fed, weaker tech, and VIX that finally opened one eye. For income and margin players, keep the buffer strong, expect a choppy payout, and let cash flow, not FOMO, drive your decisions. So what else have I been up to? Some of you saw in the live that I did 2 quick trades this week. Technically 3. On Monday, I sold the SPY 673 call for a loss of $83. But I quickly recovered as I bought and sold a 671 SPY put for a profit of $171. Later on Wednesday, I bought and sold a 665 put for a profit of $136. Net, I walked away green. But here's the important message. Because I don't have $25,000 in my account, I can get flagged as a pattern day trader. I'm using TradingView indicators that I've tested, but I need to be extremely careful, which is why I may pivot out of margin and run this account cash only. No margin equals no PBT risk. These are some of the indicators I do use, and I may be sharing that more often on the lives. So let me know if you want to see that. I also use these indicators on the daily chart to guide myself as I manage my 401k/TSP account. Those wins ultimately helped me pad some of the losses this week on ULTY, so it was nice to see that. So I just want to talk about my margin buffer here. If you take a look, my maintenance ratio did jump to 35%, but I did deleverage, only using $860 of that. Now the plan was to continue to use $1,000, but I have deleveraged quite a bit. I don't have too much time to day trade, so I may or may not go to a cash only account. I do feel comfortable in this spot, but it may be time to just make sure that margin usage just stays as low as possible. Looking back at a couple of weeks, I was sitting at 50% and using quite a bit more. So in all honesty, it could have jumped a lot higher. So again, I am happy that I did bring that amount down. How about you? Let me know what you've done. Are you deleveraging or are you still pedal to the metal? So where do we go from here? ULTI is down, the distribution is compressed, but income is still flowing every Thursday and my buffer is staying strong. This is a long-term experiment and I'm documenting every step. My strategy has always been build weekly income, keep a safe margin buffer, track results honestly, and adjust with volatility. What about you? Are you staying in your income ETF into something safer, going fully cash, or playing on the sideline? Drop your thoughts below. I want to see how this community feels right now. As always, this is not financial advice. This is just what I am doing with my money inside of ULTY. See you on next week's video. ULTY YOLO out.